We at CAIA, about 5 years ago, saw this kind of need for education, need for evolution coming in the wealth management space, and have partnered with that part of the world and launched an entire platform that we've called Unify to try to educate folks on different asset classes outside of traditional equity and debt. And so there's a lot of work. Clients are demanding it, sometimes for the right reasons, sometimes for the wrong reasons. Advisors will tell you behind closed doors and on surveys that they don't feel particularly equipped. They want to please their client. Mm-hmm. They know that there are exposures and risk return reward out there for other asset classes, but I think the industry, I worry a bit that the industry is getting a little bit ahead in some of these product architectures before we've truly trained the downstream ecosystem to accept them properly.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to episode 25 of The Bull of Wall Street. I'm Paisley Nardini, a consultant for the Wealth Consulting Group's Investment Committee, and I'm joined by our co-host, Jim Warden, the CIO of Wealth Consulting Group. I'm excited to welcome our guest, John Bowman, current CEO for the CAIA organization. For those of you that are not familiar with CAIA, which is CAIA, it is the Chartered Alternative Investment Analyst designation. That is a mouthful. Similar how we think about the CFA, which John spent some time at the CFA Institute as well. We can talk about that. But as I mentioned, near and dear to our heart in the sense that Jim and I both have our CAIA, and extremely relevant as we think about today's investing landscape. We hear constantly about the adoption of alternatives, the rise of alternatives within a total portfolio, how we can think about diversifying risks and return. And so this part of the market, I think, will only continue to grow. I think it's still fairly nascent, just based on my conversations, not only from the designation, but also from the use of alts in a portfolio. So super excited to have John here with us today. One thing too, John, just so you're aware, in my work with the Wealth Consulting Group, one of our most recent projects was to build and launch a alternative sleeve for the advisors of Wealth Consulting Group to use with their clients, because we know our clients are asking for this. And so I'm happy to share some of that insight as well. But let's jump right in. John, if you wouldn't mind, let's kick off by sharing or having you share with us your background and kind of your most recent time at the CAIA organization.
Yeah, well, first of all, Paisley and Jim, thanks so much for inviting me. Absolute pleasure to be here. I have been kind of a man of three careers, is what I often like to say. And so the first decade or so, I found myself in Boston and really cutting my professional teeth. I was running non-U.S. equity portfolios at a couple of proper Boston firms. It's a good rite of passage in Boston. So if you've ever spent any time working in Boston, there's a couple others I'd put on this list too, but you have to have had some time at SSGA and at Boston Company, right? And again, you'd put maybe Fidelity and Wellington in there too. But these are old, iconic, symbolic firms of what the Boston asset management business is. And as I said, I was taking part both as an analyst and then as a PM later in that period, running EFA strategies, developed non-U.S. equity strategies. And again, did that at SSGA. And then eventually we did a lift out and spent some time at Boston Company offering the same strategy there. I then, Paisley, as you alluded to, spent my next chapter at CFA Institute. So that was quite a departure. I was certainly utilizing the bit of subject matter expertise I had gained in my time practicing, but very much being thrown into a not-for-profit, mission-oriented, relationship building experience. And that really very much prepared me for this final chapter here at CAIA, I had kind of bumped shoulders figuratively with the former CEO of CAIA, Bill Kelly. Often CAIA and CFA, as you might imagine, are sharing the same stage, literally and figuratively, on the same side of the battlefield in almost every case. And so as a result, we tended to build up great relationship, both personally and organizationally. And in April of 19, he gave me a call and said, what about we do this together? And why don't you join us? We think the tide is coming our way and the future is here. And so that was enticing. So glad to be here. Been here 6 years. And Paisley, as you said, it's been 4 months since I took the CEO role.
Yeah, super exciting. Again, as both a CFA charter holder and a CAIA charter holder, I think the two blend, they mesh. I do think that the CAIA organization, and if you want to take credit for some of this, feel free, but I think you guys have done a wonderful job of really reaching down to the local networks and supporting practitioners' research, their, thought leadership, white papers, et cetera, really making it relevant. Because I think a lot of times, especially in the more academic sense, it's so easy to get pulled into this theory, the theoretical application of some of these ideas and portfolio construction and optimization. And then you have to sit across the table from somebody that really has to put money to work and says, hey, your optimization is great in theory, but in practice, we know capital market assumptions are only, as good as the tool is or the model is. And so I think, long story short, CAIA organization's done a really nice job of taking a lot of what is maybe still nascent part of the market and making it relevant and making it applicable. So maybe with that, before we get in, where I want to kind of start is the total portfolio approach, because CAIA has done a lot of work around that. And for those that are not familiar, I think it's a really interesting read and great application. But before we get there, I think sometimes what's still clouded a bit is this term alternatives. And alternatives can take a lot of different looks and flavors and such. So as CAIA organization thinks about alternatives, how do you define that? What's in scope? Private, liquid, everything in between?
So it's an interesting question, and perhaps it's going to be a very ironic and surprising answer. Let me first say that in some sense, CAIA, we've been around close to 25 years. I think we're like 23 and a half. So I'm rounding up a little bit to quarter century. And Paisley, to your question, in some sense, while alternative is in our name, it's the second A, as you mentioned, we have been in the business of making alternative not alternative. We're trying to make that phraseology obsolete. I think we're getting pretty close to your point, because this stuff is far from alternative or other or particularly idiosyncratic any longer. When you look at any metric, whether it's adoption in allocations at an asset owner, the size of the market, the number of GPs, the understanding in the media and in kind of on Main Street, like this has become mainstream in many ways. So I'll just say that first is, CAIA has always been about what's coming next. And things eventually move from what's coming next and frontier and on the horizon to very standard. And I think much of what we originally called alternatives, to your point, is part of the standard portfolio. And we can talk a bit more about that. So TPA, I think in many ways is an outcome, a residual of much of the alternative space becoming mainstream. So the way we define that canon, before we get to kind of the TPA portfolio, we started with hedge funds, so tradable strategies that had, quote, alternative goals in mind, whether it be absolute return or long short or macro. That's how CAIA really started. In fact, it was this, as I like to tell the story, Paisley and Jim, this figurative pilgrimage of the asset owner CIO to Western Mass, little town called Amherst, Massachusetts, if you know New England well. And in Amherst, Massachusetts is the University of Massachusetts. And they had, at the time, 20 plus years ago, really the only academic center that was focused on research around what we now call hedge funds. And they had some indices and some peer groups. And so they were kind of on the edge of what a lot of what was being birthed out of the investment banks at that time, which is really all hedge funds were. They hadn't even really created their own identity that we know now. It's easy to take that for granted now. So clearly our heritage begun with trying to solve for this dilemma that the CIOs were having. How do we integrate this crazy idiosyncratic stuff into a 60/40, which is what largely they were at that time. Now, since then, to your question, particularly as we approach GFC and post GFC, when private capital really exploded, we now include all forms and flavors of private capital, which, by the way, is the majority of the AUM now of alternatives, which we can talk about. But that includes all stratifications of private equity. So starting with traditional buyout, middle market or growth, sometimes that's called. And then, of course, early stage VC, private debt, which used to be in a financing appendage of sponsorship private equity deals, now is a $2+ trillion asset class itself, real estate, infrastructure, and what you would typically call natural resources or some other kind of long tail portions of infrastructure and real estate that have their own kind of category. All that together is kind of 25 trillion now of 120 trillion total pie. So to do the quick math for the listeners, that's about 20%, 20 to 21% now of your overall AUM is now within alternatives. So that's kind of the canon that we teach.
Can I ask a quick question on that?
Of course.
And I ask this because this is starting to creep in to a lot of alternative models, is the use of derivatives in some strategies. So whether it's derivative income in equities or within fixed income, do you guys classify, we talk a lot about buffer funds or hedged equity, downside capture. Is that still in the traditional world for how CAIA thinks about alternatives?
No, I think certainly some strategies we would cover, and you both will remember there's certainly curriculum devoted to that form of securitization and hedging and risk management. Obviously, derivatives are complex because often there's not necessarily AUM associated with it. It's leverage, or it's by definition a derivative security of an underlying financial security. So it's hard to capture that in the AUM or the asset class perspective. But yes, in the canon of curriculum and body of knowledge, you might say, it is certainly there.
Yep. Okay. So yeah, maybe we open the topic then of the total portfolio approach. This is something that's really caught on in the last several years. You guys came out with your thoughts around how to really look at portfolio construction. And it resonates with me, and maybe it's just because I come from a more institutional background, but thinking beyond the confines of asset class assignment as you're constructing a portfolio, because as we know, some of these risk premia exist outside of their neat little asset classes. For example, one of the easiest ones to think about is high yield credit. There's a lot of equity beta within that. So as you create a portfolio, is your high yield credit in your fixed income bucket, is in your equity bucket? That's one very narrow example of this, but would love to hear kind of the bigger picture framework for what the total portfolio approach, or TPA, is seeking to do. And then would also love to hear how you guys have worked with institutions or advisor clients to really adopt that within their kind of IPS statements or portfolio construction output.
Sure. You never know, Paisley, when we do these thought leadership pieces, which CAIA, resource-wise, we only choose to do this maybe once every 18 months or so. So some years we'll have 2, some years we'll have 0. But you kind of choose your battles based upon these thematic, transformational, tectonic themes that seem to be on the hearts and minds. So we're constantly, that's a beauty of CAIA and the beauty of my job. I'm constantly bumping into, rubbing shoulders with really smart people, sharing stages, and I'm just a sponge in learning. And through that mosaic of feedback and dilemmas and fears, eventually you start to get a sense through a pattern of what is top of mind. And so about 3-4 years ago, and I like to tell the story, I was sitting in a Starbucks at the bottom of the GIC building in Singapore, and I was having a coffee, which was really meant to be an intro to their newly appointed head of total asset allocation, or total portfolio asset allocation. And he had been at the firm, but had just taken on this new role. And so we're getting to know each other. I knew GIC well. He's telling me a little bit about this role. And that's where this kind of light bulb went off, this revelation went off. And he was explaining to me this transition from traditional asset class bucketing, or what we sometimes call strategic asset allocation, to TPA. And he explained this to me, and I'll get back to some of the catalysts for that. But I said, who else is doing this? And he said, well, there's kind of 3 others I talk to quite often. I said, 3? He said, yeah, I mean, I'm sure there's others doing it, but there's 4 of us that are really spending a lot of time on this. And it was CPP, and it was Kiwi Super, and it was Future Fund, in addition to GIC. And that started this idea, even though I had heard a bit about it in anecdotes and bits and pieces here and there, that this was something that really had a movement and was starting with the most sophisticated asset owners in the world, those 4 that I've mentioned, but was starting to seep down. So to your question, the motivation here is, Markowitz, who we just lost a few years ago, of course, about 75 years ago, created modern portfolio theory. And Jim and Paisley, we all grew up with this. I like to say this is the water we've swam in from our time in academia, right? Our undergrad, our MBAs, our CFA, our CAIAs, certainly our apprenticeship in the way we've grown up has all been about strategic asset allocation. And what I like to say, it's apparatus, all of its children, things like efficient frontier and the asset class taxonomy, and benchmarking at the asset class level. This all came out of Markowitz's MPT, right? Mean variance optimization, all these tools that we've used. Well, recently, as I kind of alluded to with that opening story, some of the larger asset allocators are just starting to ask the question, not whether it's failed us, but whether we need to evolve a bit in the way we think about constructing, or optimizing, maybe is a better way to put it, optimizing a portfolio towards the ultimate beneficiary or the client. And you've alluded to one of the main reasons, which in particular, asset classes have blurred. So this clean idea, or the purity of the strategy 10, 15 years ago, where you could clearly put it in one of those lanes, meaning asset classes, doesn't really apply anymore. The example I always give is, what if you had a distressed debt fund that the underlying collateral was real estate? Okay, so I've said a mouthful there that probably blows your head up. Any distressed vehicle typically has equity kickers. So let me just say, first of all, regardless of collateral, you've got some hybrid Frankenstein of some equity and debt-like behavior in the vehicle itself.
Sure.
Then I told you the underlying collateral was real estate. So do you put that in real estate, in debt, or in equity? And what
all
a TPA,
the above.
all the above. But what a TPA person would maybe flip that around and say, does it matter? Does it matter? You're constraining yourself. So a TPA person would say, let's try to optimize at the portfolio rather than in these buckets. Rather than optimizing 8 to 10 smaller subset portfolios that are led by an asset class head. This is typically how an org structure works at a major asset allocator or asset manager for that matter, is you're trying to optimize around, I've given you, Mrs. Private Debt, I give you 12%, go fill it up. Mr. Mid-Market Private Equity, I'm giving you 13%, go fill it up. Now, they're always going to fill it up. They're never going to leave dry powder because they're managing against their max.
They'll get it taken away if they do.
That's exactly right. And so the typical portfolio in an SAA model, and this sounds probably crude, and some of your listeners are going to be offended, so no offense intended. But what that typically does is you take all those subset portfolios, you mash it all together, you assume it's diversified by the sheer nature of the multiple asset classes, and that becomes your 100% portfolio. Yeah. And again, what TPA is saying is that the most optimal way to build it? Because what if the next best option was not, the 2% that was available in the private debt portfolio, but it was 2% more in the infrastructure portfolio? Why are we constraining ourselves this way when we should be looking long-term at how to maximize return for unit of risk, right? So I'll stop there, but that's been the basic motivation as to why we're moving this way.
So John, I got a couple questions on this. This is super fascinating. We're super grateful to have you, by the way. And so number one, TPA is total portfolio allocation
approach.
A total portfolio approach. Okay. So with this total portfolio or TPA approach, it really doesn't matter where it's coming from as long as you're hitting the goal, right? So if you have an asset class that is lower risk and it's hitting the goal better than something that has higher risk, wouldn't you want to increase or overweight those things that, have got, I guess, for the lack of a better word, better risk adjusted return or Sharpe ratio? I'm just trying to understand a little bit better.
Yeah, no, you're hitting on the most important part, because some people will ask variations of that question, which is, well, is there any controls in place? What about liquidity? Mm-hmm. What about your standard deviation, your risk tolerance, right? Your risk budget. What if the board says, I'm not comfortable 100% venture, but basically what you're saying is I should put 100% in venture. So of course we're not saying that. What you're replacing, as far as your tool set for management and stewardship. So usually if you're sitting on Cowper's board or Harvard's endowment board or a family office board, typically it's this ranges or specific targets for, again, 8, 10, 12 asset classes, right? That's what we're typically used to seeing. And the board in nearly every case takes that very seriously, as they should. What you're giving them in lieu of the asset class approach are usually two tools. Usually it's what they call a reference portfolio, which is simply a ratio of equity versus debt exposure. And so for each of these strategies, I described maybe one of the most complicated, but let's just say we'll take that distressed debt real estate collateral example again. You might disaggregate all your strategies and say, in this case, this is 60% equity, 40% fixed income like exposure, right? If you had 100%, if you had an S&P index fund, it'd be 100% equity, of course. If you had a treasury portfolio, 100% debt. Most of them are going to be some combination of equity and debt. So they aggregate that all up. And as long as you're kind of oscillating around what is typically like a 75-25 or 80-20, depending on the plan, the board is happy with that. They are indifferent, at least philosophically, about what those underlying strategies are and what, quote, asset classes they represent, as long as you're staying within that reference portfolio. And then the other tool, just quickly, that they will look at is, rather than going through your MBO and your capital market assumptions and then toggling all the asset classes up and down as a function of that to get you your expectation, like an actuarial rate or a spending rate, what they simply do is take usually a CPI, a total expected return plus CPI. So usually it's 4 to 6% and it doesn't matter whether the market's going down or up. Relative is kind of irrelevant. If you're trying to pay pensioners, if you're trying to pay, the university a certain amount, that liability doesn't care whether the market's up or down. It needs its money. And so use an absolute return number, and a reference portfolio is typically what you use.
Interesting.
So, as it relates, I'm just thinking about from a governance perspective, and having worked with a lot of public pensions while I was at Invesco, just thinking about how rigid a lot of these policy statements are, and to change the policies, which sometimes only happens every 3 or 5 years. Have you seen the adoption of this total portfolio approach easier in some of the more kind of foundation endowment type allocators, or even, like you said, some of maybe the sovereign wealth fund clients? I would just imagine that, like, philosophically, I know there are some public pensions that think about more through this objective based lens than asset class, but it is far and few between, at least from what I've seen at this juncture.
You're absolutely right. And I think your instincts are spot on, Paisley. So yes, endowments and foundations have been first movers in this. I mentioned just the examples, along with kind of sovereign pensions or sovereign wealth funds explicitly. You don't have to be big. A lot of people will ask after I give them those 4 examples, well, those are some of the biggest 4 in the world, of course. I don't think it's about that. I'm happy to talk about that. But some of the endowments and foundations have gone this direction too. I will say, to their credit, while the governance of particularly American public pension plans are not exactly the beacon of healthy governance in most cases when you compare them across the world to other asset owners, places like what Scott Chan has done at CalSTRS, what Stephen Gilmore now is trying to do at CalPERS, Molly Murphy down in your part of the world, in OSERS. There are several that have built a very healthy relationship with the board and are starting to move this direction. They're largely hybrid now, meaning the SAA apparatus tends to still exist, But slowly they're moving the culture, the compensation structure, and the conversation at the board level to more of a total portfolio discussion.
Okay. Yeah, that's super interesting. Jim, I feel like I've kind of cannibalized a lot of the questions.
No, you're good, Paisley. Well, so I'm just kind of thinking out loud here. With this approach, I feel like you have to still look at other things, how much liquidity you have. Because, right, I mean, if you can find the perfect asset class, obviously in a perfect world, if we know what's going on, especially like what we've gone through the last month, right, with the markets, you would say, well, I just want to buy this and I'm not going to worry about headlines and tariffs. But I feel like you still need to have some constraints to say, okay, I'm not going to pay more than this in fees, given everything else equal. And I need to have a certain amount liquid, unless you're, one of those large pensions, like you mentioned, CalSTRS, CalPERS, where they can afford to take a lot more risk to have less liquidity. But aside from that, you just really want to find the best asset classes, and it doesn't matter where they come from, right? Am I getting that right?
No, you're absolutely right. But one of the things that you also touched on, though, that I should caveat everything I've said so far, I wouldn't want to give the impression that TPA shops or adopting TPA suddenly eliminates the risk to have a liquidity budget and to think very carefully about this. I mean, any plan that has liabilities, which are the majority of them, right, that they have to think through the amount of liquidity. So by definition, you've got this overlay usually, which it doesn't necessarily play a role in kind of the competition for capital when you're going through this beauty contest of that marginal dollar and where are you going to spend it. And again, it's not constrained by what asset class it's from. It's just what is the very best next strategy, next 1% go to. The overlay of all of that is where's our liquidity and how do we make sure that we've got enough to pay, again, pensioners or the university or charitable giving in the case of a foundation. So that kind of exists. It orbits around the TPA and obviously is critically important. I would also say time horizon plays a role here. So in some sense, and I'm going to sound like I'm somewhat contradicting myself, but the beauty of TPA is that on the one hand, because it tends to lean towards more illiquid risk premia, similar to like an endowment model, but not bound by asset classes like the endowment model. It does allow you to kind of look through cycles, look through tariff bluster and trade war dialect that maybe a fully public portfolio and a shorter time horizon portfolio would require you to do. But the other thing I'd say, and what a lot of TPA shops will say, again, somewhat perhaps surprisingly, is that TPA allows me to be more dynamic. And I think one of you said this a few moments ago, and I just want to come back to this idea of bringing something to the board. In the case of a governance structure that is bound by SAA, often CIOs will tell me behind closed doors, for me to go and move my private equity from 17 to 23 to 20 to 30 requires 2 meetings, 6 months, 9 months, a majority approval. And frankly, John, sometimes I'd rather just not bother.
Yeah.
And so you can imagine by the time you get 9 months, a year out, and this thing would actually change, then you actually have to move the book that way, which doesn't happen overnight.
Yeah.
What's the point? And so it allows you, if you've got degrees of latitude that are not bound by these constrained ranges, it allows you to move the portfolio, not in a market timing perspective way, but to adjust and tweak based upon your thesis moving that doesn't require you to wait a long time to get approvals.
Yeah, that's super interesting. And I think it's also at least been maybe a Band-Aid over the last few years where some of these more, highly governed or these public pensions their hands are bound. There's not an opportunity to think about tactically taking advantage of market dislocations or taking risk off the table. And so we've seen the usage of ETFs by some large institutional investors as that proxy for liquidity. But perhaps moving to this TPA, then allows some of these institutions to stay in, whether it's funds, SMAs, direct investments, where they're getting better pricing power, where they have the ability to customize and control their exposures versus going into ETF vehicles as a proxy, and allows them to be more dynamic. So that's a really interesting point that I hadn't quite thought of. Maybe I would ask too, we've talked a lot about institutions as it relates to the high net worth advisory space. I think they're always kind of looking to institutional allocators and investors for guidance, right? We want to do what the institutions are doing. They're getting exposure and access to more diverse or more sophisticated type investments. And so we've started to see that trickle down effect, whether it's through interval funds or through a lot of liquid alternatives coming to market in the last few years. Is CAIA working with that advisory high net worth space through the total portfolio approach? I would just be interested to see, whether the advisor community can almost bypass, because I don't think advisors have really adopted that kind of strict governance of an IPS statement to the same extent maybe that public pensions have. So can they bypass all that and be forward looking and think about this total portfolio approach as a way to allocate and build models for their clients?
Yeah, it's an interesting question. It's almost like when Asia skipped landlines and went straight to mobile phones, right? When I was first starting in the business, right? And that was just so foreign, no pun intended, to me as the typical American kid that had to go through these long cycles of evolution. I think it's a good question, but Paisley, I would say that family offices are kind of already there, and I would say that it was almost by accident. It's not like they said, "Oh, well, we're a TPA philosophy. We are not an SAA." They don't think that way at all. It's just, how do I structure a portfolio with both what the owner of the family or the family multi-generations want? And so they're thinking of constructing a portfolio that suits their needs. They typically are not bound, like you said, to a strict IPS the way we've thought about it. That's not the case in every family office, particularly the ones that have institutionalized. I would say the typical advisor, the typical RIA, and again, I'm going to massively generalize here and again, probably offend half the listeners, but they tend to be a bit more, I would say, pedestrian in their allocation approach. It's usually equity, debt, and alternatives, right? And that is a framework we have tried hard, even leaving aside our alternative, still alternative. But this idea of just a third other bucket, the high octane stuff, is where we were kind of 10 years ago on the institutional side. And I think it's largely where wealth management shops are, is that here's the public equity, here's the public debt. And then we got this catch-all for all this other stuff. And should that be 10%? Should it be 15%? And we're really trying to work through thinking through the full spectrum of risk premia across all equity and debt and other forms of access and cash flow. And so I think it's just at an earlier stage. We at CAIA, about 5 years ago, saw this kind of need for education, need for evolution coming in the wealth management space, and have partnered with that part of the world and launched an entire platform that we've called Unify to try to educate folks on different asset classes outside of traditional equity and debt. And so there's a lot of work. Clients are demanding it, sometimes for the right reasons, sometimes for the wrong reasons. Advisors will tell you behind closed doors and on surveys that they don't feel particularly equipped. They want to please their client. They know that there are exposures and risk return reward out there for other asset classes. But I think the industry, I worry a bit that the industry is getting a little bit ahead in some of these product architectures before we've truly trained the downstream ecosystem to accept them properly.
I would fully agree. And I know, John, you're big on education. Jim and I are big on education as well, because if you don't have the right tools and understand what you're investing in, it's a recipe for disaster. Even if you luck out and you pick the right fund or the right manager, you probably can't explain why. You probably don't know what you're paying, what the exposures are. So all about education in any component. So not to take us in a totally different direction, but you bring up a great point, is all of these kind of micro credentials through the unified program that you guys have launched. I would love to just spend a couple minutes talking about, like, what does that spectrum of various kind of designations or credentials look like? Because our job, especially as we're launching this alternative model for Wealth Consulting Group, is making sure that the advisors are comfortable talking about them. How do we use them? What are the component pieces? Why have we put these together? So we'd just love to hear, like, what is this unified program that CAIA offers, and what types of credentials can advisors look to get?
So, well, thank you, first of all. So we have had something called the Fundamentals of Alternative Investment program for over 10 years. About 16,000 people have gone through that. So it's about as large as how many people have gone through CAIA. So that's a little known secret, that this has been a hugely successful program. And may I say, with not a lot of resources, brand awareness, sales velocity. So we have backed up and said, clearly we were onto something here. And I think historically it's been mostly asset management employees that are in sales and client service.
Yep.
But about a few years ago, to your question, we had this insight with this wealth management train moving quicker and quicker, that we said, actually, it's the wealth management value chain that is in bigger need of this. They're begging, they're pleading for some help. And it's an enterprise relationship. So historically, that fundamentals program, which is this self-paced, kind of no math, no technical work, it's more conversational. How do I just get comfortable with all these asset classes, 16 or so hours? But as we move forward, what we were hearing more and more is this wealth management value chain really needed to get up to speed across the asset classes and then down, so horizontally and vertically. And so we modernized the fundamentals program, which is still kind of our capstone course. So you get kind of a surface level overview of every one of those asset classes. When I answered your question on what's the canon of what CAIA covers, everything's covered within that. If you are a shop, for example, that has particular interest in private credit or private equity or digital assets or infrastructure or how to construct a portfolio or all the above, we have launched micro-credentials, which are more the vertical asset class focused complements to the fundamentals program. And so it's 3 to 5 hours on average. And so meaning each module is about 55 minutes. So you kind of sequence yourself through this deeper dive in a specific asset class. What we have found in these enterprise relationships, so think of almost like a SaaS subscription model. So we'll go to a large wirehouse or a big asset management shop and say, look, you have 100 people in your client service team. You've got 100 advisors in your network across the Midwest. Let's structure a deal where they all get access to this library, almost like our version of Netflix, right? And then any one individual, depending on their competency level and what they're being tasked to do, can choose their own adventure. They can go horizontal, they can dive down and then go horizontal, depending on what the firm and the moment requires. And so we think it's a very unique prospect to deliver and solution for the leadership to really raise investment acumen across the entire firm.
Yeah, I think that's incredible. I think the modular approach in this day and age, when everybody's so busy, everybody's working longer hours, getting pulled in a million directions, you want to go deeper. And sometimes it's overwhelming to look at some of these credentials or designations when, hey, I'm going to have to put in 6 to 12 months and I'm going to have to spend 10 hours a week. And so just making it more bite-sized, making it more focused, like you said, there's a lot of very niche firms now that are just focused on real assets or private credit. And so like allowing these, whether it's salespeople or the advisors who are investing in these strategies, really just picking what's relevant for them. I concur with you. I think that is the way of the future in most things we do. Modular approach, more niche. So I think that's great. So, and just to give you guys another plug, so anybody can just go to the website. It's really easy to figure out where and how to sign up for these. And these are pretty manageable from like a time commitment perspective.
Very much so. Like I said, the micro credentials are 3 to 5 hours. The fundamentals is 15 to 16 hours. That gives you a piece of everything. And you can show up kind of on the car lot as a customer one-on-one and pay kind of MSRP as a B2C sale. As I said earlier, about 80% of our sales, though, this is much more of an enterprise solution typically. So everybody from the wirehouses in training their sales staff on alternatives to, for example, we had an asset management shop that you would know as a traditional asset management shop, right? Mutual funds, long only, kind of heritage and history. But little did we know they had a really interesting private credit business they had bought, and they had a hedge fund business they were incubating. And they came to us and said, look, I'm not sure that all the team needs all the fundamentals. Some of them might find that interesting, but we particularly need to execute and proliferate knowledge on private credit and on hedge funds. And so that was a particularly interesting, again, it can be bespoke and customized to the specific need.
Yeah, I would also imagine too, for anyone listening that owns their own RIA, even if it's not these massive platforms, if you're starting to adopt alternatives in your models or your portfolios for your clients, and you have an advisory team that maybe is 10 to 20 people, relatively small compared to some of these bigger firms we're talking about, this is still something you could even give access to just to help educate and kind of close that gap to make these advisors more comfortable with, what they're putting in the portfolio. So I love that. So I'm glad we spent a couple minutes on that.
So John, what I love about this is it's coming from you. It's coming from CAIA. It's not coming from any particular fund company. And so I feel like this is a really good objective way for advisors to learn, in the safety of not having the pressure of, someone trying to sell them something. So I just got back from a conference and, there's all kinds of people talking about various private credit and private equity strategies. And I'm not knocking any of those, but I just feel like for advisors that are new, that they're just learning about it. This feels like a safe place. And so kudos to you guys for doing that.
Well, it's such a good point, Jim, because I think one of the questions we get often is, our friends at BlackRock, Blackstone, iCapital, and you could go on and on. They all have their own university or training programs. Some of them are for use down into their wirehouses, right? So they're somewhat arm's length. Others are simply for their employees. How should you understand BCred, just to use Blackstone as an example?
Sure.
And what is it used for? How should you talk about it? To be very clear, I think there's a very important role that those internal universities, internal training programs still play. They need to understand the mechanics. Again, back to my car metaphor, when you're sitting in that car on the test drive, you want to understand what the upgrade packages are and what all the buttons do, and you want to take advantage of that. And that's for the manufacturer, to the story. But I think what we're trying to do, and I think to your point, we are uniquely qualified, perhaps the only organization that can do, is to back up and just say, what are the questions you should be asking about whether alternatives, again, with semantics questions aside, alternatives, private capital, private credit in particular, is right for you given your goals, your family situation, your liquidity needs, your risk profile. And that's not really for our friends on the GP side to answer, or at least it's harder for them without I would say commercial interests or bias or even optics leaking in, no matter how hard they try.
Yeah.
I tell them this all the time. It just is there, and they shouldn't apologize for it. They're commercial organizations. So I think we live a very peaceful coexistence, because I think you need both to be prepared
absolutely.
to sell this.
Yeah. So maybe the next question I would have for you is just thinking about the convergence of public and private, some of these alternatives and more traditional assets. And part of what CAIA is doing, which we've just spent quite a bit of time speaking about, is really educating. I would imagine another part of your guys' mission is really to advance the use of alternatives within a portfolio. So what implications do you think that this convergence of public and private has on where the industry's headed, whether it be new businesses, business development, talent development? How do you think about that?
Yeah, I mean, there's a lot there. It's something we're thinking about and speaking about quite a bit, this great convergence, Paisley. So first of all, we are proponents of more exposure to what we've traditionally called alternatives. I just want to put a caveat on that, is that we are not a trade group or a lobbying group. So we want that to be done with responsible stewardship of the client. If we have any master we're serving, it's not the GPs, it's certainly not their products, it's not the LPs either. And there are great organizations that do all that we're friends with. But ultimately for the greater good, the whole capital market system and the client specifically. So I would just say, yes, we do think there is meritorious benefit to long-term access to all this risk premia, but it has to be done properly and responsibly. So just a quick disclaimer there. The great convergence. So this is happening in so many different ways, right? There are shades and shadows of convergence happening across the business. The asset management businesses in the private and public lived very separate, parallel track lives for the 25 years I've been in, almost 30 years I've been in the business. I mean, you went to Wellington and T. Rowe and BlackRock and Franklin Templeton, to stereotype, for one thing, and you went to Apollo and KKR for something completely different. And, just to be particularly hyperbolic, they didn't cross paths, they didn't intersect with each other. It was a very different model, culture, recruiting process, sales pitch, right? And even clientele.
I might even pause and say that's traditionally how portfolio construction has been approached as well. Very segmented, black and white, different process for due diligence, different teams, So case in point.
That's right. The convergence that I'm describing, the other side of that in portfolio construction is what we've already talked about. TPA to me is the mirror image of what we're talking about in the firms starting to kind of intersect and collide in many ways. So that's the outcome. But I think from a structural standpoint, and I've just alluded to a few, every one of those, quote, traditional organizations have started to build in their own laboratories or buy very aggressively a lot of private capital capabilities. And I don't know that pure plays in one place or another are going to make much sense in another 5 to 10 years. So if you're coming from the direction of the GP that has great manufacturing in private equity or private credit, you are trying to aggressively, desperately build distribution into mass market and private wealth. Yep. If you're coming from the traditional side, you've got distribution, you've got clientele, you've got amazing client acquisition skills and flows, but you don't have any product or manufacturing on the private capital side. So they admittedly are coming from different starting points, but man, are they bumping into each other. This bumper car game is getting very violent between those two previously independent worlds. And so then if you go down one layer, Paisley, which was also part of your question, the products themselves are starting to reflect the convergence of the firms as well. And so when you see combinations like Capital Group and KKR creating an interval fund that has both public and variations of private credit, like that's fascinating, really interesting stuff because it gives you full access to that risk premia. And BDCs are a bit of that as well. And I think we're just seeing we're in the very early innings. And by the way, I think there are good versions of this product creation, and there's probably not so good versions. So I'm not suggesting all of this is good. And as I said earlier, if anything, it's moving slightly too fast in my view. But the point is, I think we're all trying to find our way through this disruptive tsunami of product creation. Like, what is the best combination of public-private, of liquidity gate, of access, of minimum? Should it be registered? Should it not? There's all these kind of competing factors in how you're designing the Maserati, and we're just trying to find the right kind of combination or technical specs to get this right.
Interesting. Do you foresee, like, with all of the new developments with AI and large language models, do you feel like this is going to get easier for certain investors, especially maybe those investors that are not the large sovereign wealth firms or pensions, but for smaller, maybe not mass affluent, but some mass affluent certainly, and then certainly with the high net worth, does this help with due diligence, the AI and all that, and selecting the right products to fit it? Because, like, as you said, there's sometimes the cart does feel like it gets in front of the horse, and we're trying to like back things up because we develop products before there's really a need, and then we're like, well, I don't know if that's a good product.
Yeah. Well, I think that's a good that's a good reminder of the last bit of Paisley's question. So let me segue that way, which is the talent implications of all of this convergence and the intersection of AI and what influence does that have. So again, I don't want to speak for the two of you, but I described you asked me about my earlier career, and I grew up in kind of the very traditional CFA archetype, long only investment analyst, fundamental analysis, building my own model. And that job is largely going away. At least it's a fraction of what it was in the 90s.
Sure.
When I started in the business. And part of that is this shift towards alternatives and more complex, I would say, sophisticated allocation of resources. Part of it is the move towards passive for much of these, I would say, highly efficient asset classes like large cap US, which is where I started. Even small cap US, do you really need an army of analysts when it's really hard to beat the benchmark in those areas? Like, shift your alpha focus to areas where you can really make a difference, right? We've all heard that. But then I think also is AI. And AI can do, I was telling this story to my son. I was visiting him. My second son is in Vermont. He's in wealth management, actually. He's the only one of 6 that's following in his father's footsteps. So I don't know about that ratio of success. But anyway, I was telling him, when we were young, and you've all heard this stereotype, I was following retail and tech was my first job. And one of the things we did in retail is, the old visit the parking lot on Tuesday afternoon. How many cars are there, right? And
sure.
You're like modeling. Tuesday at 3, last week it was this, now it's this week. Like, Walmart's earnings are going to be up. That geo-tracking can do not only that without you leaving your desk, but of much more importance, I was telling my son, it has access to this unstructured credit card data. So you don't need to look at the number of cars. You actually can look at the transactions. You can go one step further. So all of this unstructured aggregation, curation, and eventually combination to spit out insights. Now, you still need, and this gets to Paisley's question, you still need somebody that has critical thinking, analysis, judgment, lateral systems thinking capability. And I think that's where our industry has largely failed, because historically what we've raised are folks like me, somebody very vertical. They go through undergrad and MBA, they do their CFA analysis. They are skilled deeply in one or two things. They're very specialized, and we slot them in, and then you kind of work your way up to portfolio manager, and it's been a very vertical ladder. And I think this idea of a lattice going forward, where you can move sideways and across, and you've got multidisciplinary ability to engage on how geopolitics and AI and a lot of competing forces around the world are influencing either your TAM or your earnings growth or a market's health or so forth. So I think the future analyst, the future individual for these converged multidisciplinary firms needs to be a multidisciplinary thinker. And I think, frankly, we've got a lot of work to do as an industry in helping to almost rewire our entire developmental academic process by which we source talent.
Sure.
So I work with a lot of undergrad students who are majoring in economics, accounting, finance, and looking for advice on entering the industry. And of course, go out and get your CAIA is probably at the top of the list. But I think it's really important what you bring up, just really about how our industry is growing and how the firms in which we're seeking employment are also evolving. Do you have any advice for some of these like younger students that might be listening in as to how they can navigate this beyond maybe going out and getting their CAIA?
Yeah. Again, I think it's multidisciplinary capability. And, look, I'm the product of a liberal arts education, so I'm biased. And I think communication skills, the ability to ask good questions, critical thinking, logic skills. I mean, business ethics, right? And kind of fiduciary responsibility. These are things that are taught in a liberal arts business education, but are not really taught in a deep finance course. And so we're spitting out very smart, but very specialized individuals. And I don't think they're going to be well suited for the future. So advice would be, yes, I'll mention CAIA only because it's a product of this thinking, not because we think it's the holy grail, Paisley. And that is, we have gone away which I think if you would have looked at the curriculum, I don't know when you guys earned your charter, but
2019 for me.
2015 for me.
Okay, so Jim's
an OG.
Jim probably saw more of what you might call the old model, which is similar to our TPA discussion. It was a bunch of silos. You were studying the specifics of risk return characteristics and the makeup of each of those asset classes, and then you would come out as at least a workable expert enough to be dangerous on any one of those things. And what we've said is that really how the future world is going to work? I'll have this discussion with an analyst, let's just say at a real estate GP, and they'll look at me and say, why would I study hedge funds? I work at a real estate GP. And I say that when you're talking to an LP or a consultant or a client, they're not thinking about your real estate fund or strategy or the valuation of said building or the cap rate of that opportunity. They're thinking about how does this fit within the portfolio?
Yeah.
Sure.
And what does climate risk have to do with that building? And by the way, what if some of this tariff stuff that you mentioned earlier comes through? And by the way, China suddenly has got a much cheaper route to AI, and I'm just throwing a bunch of stuff at you.
Sure.
And that level of kind of mosaic of systems thinking is not what we're preparing our future talent for. So I think it's finding ways to engage with other disciplines, finding mentors across outside of your comfort zone, looking for organizations that perhaps are moving you laterally and getting you exposed to all portions of the business. Because again, if you're following that old path where I'll pick on the real estate person just because I mentioned it, but real estate, valuation associate, then real estate analyst, real estate portfolio manager, ultimately GP managing partner of a real estate firm. I'm sure you're going to have a great career, but you're not going to be very flexible and dynamic in the way that you could navigate yourself across the industry. And I think that will be the future will demand much more of that than we've had in the past.
I think that's great. I think that's super helpful. I mean, my takeaway from our conversation today is not only do our portfolios and the way we think about public and private, but also just from entering the industry, like just more dynamism really, and how we think about this being more fluid, being more flexible can really produce greater outcomes and greater success. I know that sounds a little bit cliche, but I think that's kind of the commonality across much of what we spoke to. I maybe have one last question, then Jim, of course, if you have any as well, but the agenda for CAIA over the next couple of years, like as you've taken on the helm, as you're engaging and traveling globally to meet with individuals and businesses all over the world, like what's the top priority for CAIA in the next couple of years?
Well, there's a couple there, and you, as you might imagine, as a brand new CEO, this is the topic du jour with the board: is how do we think about our future? How do we move the slope up a bit in our growth? And so if you've seen any of my LinkedIn posts, I've been talking a lot about our Vision 2035, as I'm calling it. This is the 10-year strategy, and the board and I are kind of journeying through this collective discovery and ownership of a new 10-year strategy. But to answer your question specifically, Paisley, I would say reshaping our identity. And it's much of what we've talked about today. So I don't want to be known as the alternative credential. Like that would be a miss. Yeah. And also a mismatch versus what's in the box, if you will, right now. Because CAIA from the beginning, although we didn't talk about ourselves or articulate it quite this crisply until recently, we've always been, as I like to say, kind of the community that understands and is examining and helping each other look around the corner. What's over the horizon? What's lurking behind that next obstacle, right? What's coming next? Hence this new mantra we've got, which is kind of next is here. That's our just do it equivalent. Next is here. So it's not about the other stuff, again, to our point on equity, debt, and other. It's about what's coming next. So I would like to think that the credential and the association is thought of as having their finger on the pulse, and a community that when you enter the room, figuratively, like the palpable energy of the future is what you're experiencing. And man, is it worth your time? Is it create career opportunities? Obviously, but is it simply fulfilling and allow you to do your job better? That's what I want CAIA to be known. So there's the brand, and that's That's kind of the nebulous, subjective stuff. Scale is the other one. I think one of the things we do wrong, and with all due respect to a lot of my contemporaries, one of which I worked at, right? These are all great firms. I think we often confuse ourselves, back to my kind of car lot analogy, that the way that prospective candidates shop for their educational opportunities is to like open up the body of knowledge and kick the tires, and what does the sunroof upgrade cost, and what if I get this this premium color. I think that's part of the journey, and you guys correct me if I'm wrong, but when I talk to prospective candidates around the room, it's all about what is entering this community or this tribe, or what is wearing this new uniform do for me? Mm-hmm. Does it give me a more fulfilling career that equips me better to be great at my job? Does it give me a promotion? Does it give me a better pathway? Does it make me more marketable? And I think that all comes back to community. We just changed our mission to, we're building the most energized community of investment professionals around the world. That doesn't say anything about the means by which we do it, which of course is education and fiduciary and ethics and teaching all those things. But if we don't start with the fact that this is a network economy business, just to get technical, that every additional member makes Paisley and Jim's CAIA even more valuable than the next one. So the business model is actually ironically closer to a social media business model than it is an MBA program.
Yeah.
And I come back to where I started. I think the industry gets this very wrong. And as a result, the ethos and the branding and the way we talk about ourselves misses the point. And I want to reconnect with the underlying individuals that make up the community. And that's what we're going to really be focusing on.
Yeah, I think that's so important. I mean, you need the local boots on the ground, society, communities, networks of the CAIA brand to carry that torch. And then I also think too, as an individual, if you're investing the time and the money to get this designation, and then you get the job you need, or you connect with whom you want, then what? Do you just say, okay, great, I got what I want, who cares anymore? Or do you put time and energy back into that network? Because I personally can share, as both a CAIA and a CFA charter holder, I'm the president of CFA in Orange County. And the more that I give, the more that I get. And I always like to remind people, whether it's CAIA, whether it's CFA, or whether it's any other designation, if you keep giving into that, you'll keep getting out of it. My network continues to grow as a result. So I would say for those that are sitting for the CAIA or have achieved have the letters at the end of their name now, get involved, volunteer, continue to network with those local organizations, because like you said, John, as it grows, there's just a wider network that you then can tap into with minimal effort. And that's really what getting involved in all of this is about. So I love that.
Yeah, no, I appreciate that. You've been a longtime volunteer. And I think I would just raise you even more than the way you described it, Paisley, is like, I'm getting so much out of this, I can't help but want to give back.
Yeah.
Right? It's like the sequence is slightly reversed. Like
yeah.
I am so anxious to be an ambassador and a voice, a megaphone for this organization, because every time I come in contact with this community, it gives me energy. I leave better off. And that is easier said than done. But it's something that we aspire to and are working really hard at.
For those of you listening, we've all drank the Kool-Aid, if you can't tell. This is not a cult.
I would just add, John, you guys, and I think in conjunction with CFA Institute and this alts organization and markets group, you guys have done a great job with these alts LA, and I might see you if you're there at the alts San Francisco, and I noticed that these are great, really great platforms for people to network. And I just feel bad because I haven't done a lot of those. I haven't done as many as I would like to, but I went to Alts LA. I saw Paisley there, and I saw probably a dozen people that some of them I haven't seen for years. And it was such a nice reunion to see people and say hi and all that. So
yeah, it felt like a college reunion. I unfortunately missed a lot of the quality presentations because there was so many people in attendance that I hadn't seen for years, as you mentioned, Jim, that you wanted to catch up with. It is like the network's growing and it's so valuable. So appreciate all the work that you're doing.
You did miss my session, didn't you?
Yeah.
I missed your session too, but I spoke at a panel and very, very last session, so I should have been there the whole time. But
yeah, I'm teasing you. But it's funny you say that, Jim. Just real quickly on that. You know, that was what seems so obvious now, to have a series and a platform of alts conferences, because that's what everyone wants to go to, right? I mean, who wants to go to a traditional asset management conference anymore? No offense to anybody, but people want to go to alts conferences. But 11 years ago, when we thought this up, like, that was novel and risky and crazy. And it was, you're right, it was CFALA, CAIA Association, and Cal Alts thought, well, let's just try this. And it went so well. So CAIA has now worked, we had to hire Markets Group because we didn't want to run a conference by ourselves and do food and beverage and room blocks. And so Markets Group has been our partner, and we've now parlayed that little Southern California event now into 13 events around the world. And San
it's
Francisco
amazing.
Another one.
It's incredible. There's a guy that I'm connected with on LinkedIn, and we've, exchanged some messages, and he's from Peru, and he was there, and he was there right after I finished my session. He's like, great job. And I'm like, well, it's so nice to meet you. And you came all the way from Peru. So that's awesome. That's amazing. I think you guys are doing a great job to attract those people to those events.
Yep.
Well, thank you. Yeah.
Wonderful.
One final question.
Yeah, go ahead, Joe.
I'm sorry, Paisley. I just only have one final question. So you've traveled all over the world. I see some of your videos. You're jogging. Kudos to you, because I need to exercise more when I travel. But as you talk to all these places, and it could be the Middle East, it could be Africa or Asia, like, what's the one thing that you're really learning from these people? And because I feel like the rest of the world is really starting to get caught up with what alternatives are and why we need them, and why this is helpful, and why CAIA is helpful to plug into for both the network as well as the education. What would you say is the biggest few things that you've learned?
Yeah. The running videos keep me sane, I will tell you. If I don't work out on the road, it's even less about physical shape. It's more about just my mental health, to be honest.
Sure.
But thanks for noticing. So I would say that, look, the adoption and allocation of alternatives, regardless of where you are on the value chain, or that daisy chain of actors. So from the manufacturer down through any intermediary, through an advisor, through the last mile of the ultimate client, right? And any form or formulation of said daisy chain. It's a journey. It's not a binary decision. It's not a moment. And I like to think of CAIA as being a bit of a Sherpa, for lack of a better metaphor, that walks with each of those actors. And we have solutions and mechanisms and relationships to touch and help and support and educate, if that's the case. Every one of those stops on the value chain. And my view is that you've got to have all of those players along that value chain aligned, moving for the same reasons at the same pace. When one gets out of whack, either because they're undereducated, or one's moving faster than the other, or commercial goals outpace fiduciary responsibility. And look, commercial goals are fine. They just have to they have to be paired with and have coexistence with fiduciary responsibility and stewardship of the purpose of why you are making money off of a product. And so CAIA, to me, is really meant to be this navigational tool to help the world move faster. Now, you're right. When I go to places like Saudi versus China versus Singapore versus Orange County, that daisy chain is in different places, and each of those stops along the needs something slightly different. But ultimately, it's about just serving the underlying client. And I think CAIA is in the right place at the right time to just offer a lot as everyone pursues their own journey towards better diversification, better long-term portfolio outcomes, and better care for clients.
Wow. That's amazing. Thank you so much for your time.
No,
yeah, I really appreciate you joining us today, John. I would be remiss also if I didn't give you guys a little plug for your podcast, which is Capital Decanted. So after you guys listen to this episode, feel free to cruise on over to Capital Decanted and check out John's work. He is obviously a pro on the podcast scene. So thank you again, though, for your time. Thanks for everything you're doing for CAIA, and really appreciate our time today.
Yes, thank you. And if you want to go to CAIA.org, that's the website, right? For people that want to learn more?
Yeah, absolutely. And you can
CAIA.org.
Yeah. So anything to do with what we talked about with Unify or the credential itself, or by the way, forget the commercial side. We have a ton of resources. And again, I'm biased, but from thought leadership, meaning long form stuff, to podcasts, as Paisley mentioned, to blogs and newsletters, all this, the large majority of this stuff is just out there for the greater good to be digested. You don't need to be strictly a member. But listen, for 2 members, I'm happy to do this anytime. I appreciate you two for your membership, for being part of the community. This movement doesn't happen if we don't have dedicated folks like the 2 of you. So I just need to multiply you by about 20,000.
Yeah, we're out here carrying the torch.
Come and dance on our floor. Take a step that is new.